Good morning and welcome to today's KraneShares webinar, a DeepSeek-driven KWEB re-rating. My name is Brendan Ahern. I'm the Chief Investment Officer here at KraneShares Exchange Traded Funds. Earlier this morning, Alibaba beat analyst expectations driven by a rebound in their core China e-commerce business, a rapid growth in their international e-commerce, but most surprisingly to some, is a rapid growth in their cloud computing unit. As CEO Eddie Wu stated in today's conference call, he stated revenue growth at Cloud Intelligence Group was driven by artificial intelligence, which will continue to accelerate. Today's webinar, we'll take a quick look at what's been happening in the technology space, not only here in the United States, but in China around the DeepSeek model announcement several weeks ago. We also want to take a quick look at some of the investors that are currently investing in Chinese equities, as well as what we think are some of the potential catalysts that are on the horizon. Joining me today is James Maund, our head of capital markets, and Jonathan Shelon, our chief operating officer. James and Jonathan have spearheaded our efforts to take KWEB, our China Internet ETF strategy, and evolve it into a number of new strategies, allowing KWEB to become an income enhancement tool, as well as providing buffered and principal protected versions of KWEB. Please proactively ask questions during the webinar as we hope for a lively Q&A post-presentation. If you're viewing us today on KraneShares.com, please email any questions, or if you'd like to receive the PowerPoint, at info@KraneShares.com. For those of us joining today on Zoom, please use the Q&A button. For CFP and SEMA continuing education credits, please email us at ce.com. Very quickly, for those of you less familiar with KraneShares, our founder, Jonathan Crane, formed two core beliefs during his experience living and building a successful business in China. These two beliefs were the basis for founding KraneShares back in 2012. The first is that while new China sectors such as domestic consumption, internet, e-commerce, 5G and semiconductors, clean energy, and healthcare have become the new drivers of China's economic growth, these sectors are still underallocated in global portfolios. John's second thesis was the opening of China's mainland equity markets, the second largest in the world, as well as China's bond market, also the second largest in the world. That opening up would have a significant effect on investors' portfolios in the years to come as these markets are included in global indices. Most importantly, we endeavor to earn the trust of investors through our balanced, data-driven perspective on China's economy and capital markets. China's rise in market indices, as well as in the global economy, necessitates investors have a partner to navigate these developments. We here at KraneShares endeavor to earn that partnership role with you. We maintain a daily research blog that is available at www.chinalastnight.com, which we encourage you to subscribe to in order to keep abreast of new developments as they occur daily. Again, please submit all questions, or if you'd like to receive the presentation, at info@KraneShares.com, or if you're joining us on Zoom, please submit any questions over the course of the presentation using the Zoom button. Now, obviously, many of you are aware of our suite of China exchange-traded funds, but there is much more to KraneShares than just our efforts in and around China. Our colleague Luke Oliver heads our climate efforts. That KraneShares was the first provider of a carbon credit allowance futures ETF here in the United States, as well as we've partnered with firms like global macro research firm Hedgeye to provide a hedged version of S&P 500, as well as Nancy Davis of Quadratic Capital with iVol, as well as our friends over at Mount Lucas with our managed futures strategy, and most recently with the Man Group with a strategy that applies private equity buyout ratios and applies it to public equity. So certainly there's a lot more to KraneShares, certainly our three pillars being China, climate, as well as alternatives. Now let's dive right in. I think since really up until very recently, I think there was a general consensus view that the AI evolution was really just solely driven by US technology firms. And I think that myth has been shattered by DeepSeek. DeepSeek, a spinoff from a Chinese hedge fund called High Flyer, that was able to leverage a lot of the effort from OpenAI and other AI early investors to really take those efforts where billions of dollars were built, building a foundation. They were able to leverage that and actually build the proverbial second floor very inexpensively, as well as in a very energy efficient, as well as not utilizing the super high-end semiconductors that I think many believed were necessary. So in general, the disparity between the enthusiasm for all things AI was really solely a US phenomenon, and everywhere else in the world, including China, there was no reward, there was no valuation premium given to those companies. And I think DeepSeek's announcement, particularly where they're doing it in an open source manner, they're literally giving it away, simply shatters that view. Now, on the next slide, I do believe that it will take time. It'll take, it might take a year, or it might take 3 years for us. Was this moment in January, was it a truly an event that marked a regime change in terms of market valuation, where investors were positioning themselves, valuations? I don't think we can say definitively that the DeepSeek moment shatters that this is solely a US, but I think it arguably does. There's early indications of that, because what DeepSeek showed is that investors globally have really been overweight one trade, that US equities is really a US tech play, which is really a Mag 7 play, which is really a Nividia play, and a lot of other trades around that. If it's, you're going to need very high-end semiconductor chips, that you're going to need a lot of energy, you're going to need data centers, potentially need nuclear energy or LNG. All of that, I think, has been shattered by DeepSeek. It's really exposed this very crowded trade, and it's forced investors to actually do some math, to actually say, look what the market is valuing US AI plays, and then conversely, look at how inexpensive the China plays are in comparison. So we believe this is, potentially this is part of the re-rating process for Chinese equities, particularly those companies geared to AI, such as we're seeing with Alibaba and a host of the technology and a host of the companies that we hold within KWEB. Now, on the next slide, I think it's key that this outperformance, driven by this global enthusiasm for all things US AI and technology, has led to, over the last several years, a bit of a disparity between, say, KWEB and US technology stocks. It is worth pointing out that over the last year, if we go back to the January low in Chinese equities, KWEB is outperforming the U.S. equity market, the S&P 500, as well as the NASDAQ 100, pretty significantly. Now, I think for most investors, you wouldn't believe that, because I think an element has been the media narrative on China has been so negative that you'd think Chinese stocks are down 40%, not up 40% over the last year, but they're actually outperforming in a significant fashion. Now, on the next slide, I do think that an element of what's happened over really the last 15 years, where we have this very significant outperformance of US stocks relative to non-US equities. It's led to a very, very crowded positioning where upwards of 2/3 of the global equity market cap is in US stocks. And again, I think when you filter that down, you can see it's really, really overweight to a small number of stocks. And this DeepSeek moment potentially shatters a little bit of what if we don't need those chips? I mean, the repercussions for Nividia, the repercussion for valuations of US technology is very, very significant. And it's our belief that investors are unprepared, not just for non-US equities potentially to outperform, but very more specifically, not just Chinese equities, but really the Chinese tech companies. Now, what we have seen is that there are some investors that have been noticing what we've been banging the table on for the last year. On the next slide, there are some investors who have been early adopters. The first type of investor that we've noticed is very, very interested in Chinese stocks are technical analysts. Now, again, I mentioned that over the last year, you would never think KWEB is up more than 40% because you'd think every 2 steps forward has been 2 steps back. But that is not true. China has been going 2 steps forward, 1 back since this derivative-induced capitulation low a year ago. And what's interesting is why technical analysts are very interested in say, particularly KWEB, but Chinese technology, is that it's actually been higher highs and higher lows, which is the definition of an uptrend. Now the other investor from a fundamental basis are the analysts, the research analysts who cover the companies in KWEB. And what those analysts are saying is that MSCI China is not growing fundamentally. It's not. Now, some of that is just because of the sector weights, the high weights to financials, energy, materials, real estate, industrials. But there is within that MSCI China, there are companies that are growing. And that is the internet stocks. And universally, if you look at Wall Street analysts who cover the KWEB companies, they're very, very bullish and certainly validated by Alibaba's financial results. But we also had the results of Bilibili, another one of our holdings that outbeat expectations. NetEase was a little bit mixed. But again, technical analysts, fundamental analysts. The other buyer of Chinese equities today are the companies themselves that, as Alibaba announced today, they spent almost, I think it was just about 2 billion, not quite 2 billion, just under 2 billion, buying back their own stock over the last quarter. And then that's true not just for Alibaba, but for peers like Tencent and Meituan and others. And why is that interesting is that if you look at each of the companies within KWEB, the founder is either the CEO or the chairperson. And if you're a tech entrepreneur, if you thought that your company's prospects were not looking good, you'd be hoarding cash, not using it to buy back stock. But across the board, we're seeing very, very strong buyback programs. The other buyer has been investors in China who are utilizing it's called Stock Connect. It's a program that allows mainland Chinese investors to buy stocks in Hong Kong. And the Hong Kong Stock Exchange daily publishes what are they buying, what are they selling. And it's been remarkable. In 2024, those mainland investors bought $103 billion worth of stock versus 40 billion the previous 2 years. And universally, when those investors buy stocks in Hong Kong, they're buying the proverbial KWEB companies. They're buying the growth stocks listed in Hong Kong. And year to date, we're up over 20 billion. In the month, it was 15 billion in the month of January alone. We're up over 20 billion through halfway through February. They're on pace to buy significantly more than what they did in 2024. Now, the other buyer of Chinese equities that we've seen is by looking at SEC filings of some pretty significant investors in the hedge fund space, both U.S. global investors. An investor that I think any investor who follows the markets has a deep respect for, legendary investor David Tepper and his hedge fund, but a host of other hedge fund managers, another investment legend, Howard Marks. But there's a whole host of are actually been filing that they're buying Chinese equities, Chinese ETFs, and some of them actually buying KWEB. And we'd argue that an element of that is just simply that they're just simply buying low, potentially selling high, selling things that have done well, and just buying low. But we also believe that these managers are potentially unencumbered by the geopolitical, the media narrative, which is always negative, and which I think has kept a lot of investors on the sidelines. So I think we see a host of investors coming in today already. But on the next slide, we think there's some catalysts which will potentially relieve some of these headwinds, some of these constraints. And by far the biggest is the geopolitical constraint that the media has parroted, I think, a very anti-China the last several years. And just as we saw overnight, I think President Trump was on Air Force One, was asked, can you do a deal with China? And he said, maybe. That he said he has a very strong relationship with President Xi. And we think it's, as President Trump himself stated, that he wants to visit China in his first 100 days. And we think President Trump going to China, him then doing a deal with President Xi, removes that geopolitical headwind that has kept many institutional investors, not just here in the US, but potentially globally, from buying low, from coming back into Chinese equities. We also think that why China will do a deal with President Trump is because China is grappling with a real estate crisis, and there's things that they're doing to rectify it. But from being in China in just a month ago, it was very clear that the whatever it takes stimulus necessary to rectify what's been going on in real estate, the very significant policy support, requires doing a trade deal. Now, again, China is doing stimulus. We're seeing that trickle into the economy. We think that's part of the re-rating, but we also think that's why you've seen President Xi meeting with tech entrepreneurs, including Tencent's Pony Ma, including Jack Ma of Alibaba. Is that they know that they need the private sector, they need the domestic consumption story to rebound. So we think there's a lot of investors have been on the sidelines. We think this geopolitical narrative going away helps bring those investors back into the market. But again, we're seeing a whole host of investors coming in now. I think that's just the perfect segue, because a lot of what we're speaking about there's going to be volatility when it comes to KWEB, and James and Jonathan have really put on their financial engineering caps and have actually created some really, really interesting implementation tools for investors that we want to reintroduce. I'll hand the baton to Jonathan and James at this juncture.
Fabulous. Brendan, thank you. And what a compelling case for China internet and the China story at this point in time, fueled by AI and just extraordinarily attractive valuations. I'm really excited to be speaking with everyone today. As you can tell, our job at KraneShares is to deliver high conviction investment strategies to you. And we have strong beliefs about how you should invest in China, and believe that for many investors, China can represent 10% of your equity portfolio. Most investors don't hold China at those levels. But the truth is, we don't know what your overarching objectives are. We don't know what you or your clients are setting to accomplish in your portfolios. So we've closely consulted with many of you actually on this webinar to establish a set of tools that can help you manage your client money or your own money in a way that better aligns with your goals. And we've developed a comprehensive suite to do so. But before I talk about that, Brendan highlighted the benefits of KWEB and how it's performed recently, much better than many believe. But I also want to highlight that not every investor can use KWEB or wants to use KWEB as a standalone category. Some investors would prefer to have broad-based emerging market exposure. So what KWEB actually has is a smaller brother called KMQ, which provides many of the themes that we talked about, that Brendan talked about, but does so across emerging markets, because these themes are prevalent not just in the US, not just in China, but really across the globe. And while KMQ is KWEB's smaller brother, it does pack a big punch. So for those of you interested in broad-based emerging market exposure, it's certainly an option I'd ask you to consider. But moving over to this China volatility suite, we spent a lot of time doing research in this space, starting about 3 years ago. And after quite a bit of R&D, we launched KLIP, which is our option income strategy. And I'll spend time on KLIP and go into some detail about it, but it's a strategy that writes calls on KWEB and then pays out a 2% distribution. And we've made some enhancements across the suite that we'll share as well. And then we also have, of course, KPRO and KBUF. These are strategies that have a 2-year tenor. So they go out to January of 2027. And they provide upside capture, participation, if you will, 20% upside for KPRO, which has a 100% buffer. And then KBUF has 40% upside, but it does require some capital risk with a 90% buffer. So let's get into some of the details and understand how it is that we were able to build such a nice comprehensive suite. And the answer is straightforward. KWEB has an enormous and liquid options market associated with it. Now, while we ourselves are not part of promoting or sponsoring the options market, usually as ETFs reach scale, options begin to exist and can become quite attractive. Right now, the options market, KWEB, has about $7 billion in notional open interest, which is nearly as large as the fund itself. And you could see that no matter how you rank it, whether you're looking against other China ETFs or emerging market ETFs, or even the entire universe of ETFs, all 3,000 plus of them, the options market for KWEB is a top 15 market. This has given us tremendous flexibility and capability in identifying strategies to manage risk. Next slide, please. So let's just do a quick review on how KLIP works. KLIP is our KWEB covered call strategy, and it does a couple things. First of all, it buys KWEB, so we own KWEB directly. This is a little bit unique in the marketplace because you'll find that a lot of covered call strategies, particularly those based on US indexes, may not own the indexes or may not own the ETFs. They'll invest in the individual securities. We actually buy KWEB, and there's a reason for that, and we'll get into it. But then what we do is we write at the money calls. At the money calls give us the ability to generate maximum income. So this is important. And we write them over a period of time, which is usually 30 to 35 days. Again, that too provides greater income potential. And every month we roll those options and reset them and push them out another, called 30 to 35 days, depending on how the calendar falls. So if you think about KWEB as giving you uncertain upside and uncertain downside, and when you write a call, you're substituting the uncertain upside for cash, for option income. When you use higher arithmetic and add those things together, what you're left with in KLIP in an overall covered call writing strategy is option income plus uncertain downside. And that's important to understand, right? You're substituting something that could be quite volatile to the upside, as Brendan highlighted, for a high level of cash income, but you still maintain some of the downside characteristics of the thing that you're writing calls on, in our case, KWEB. But that option income acts as a cushion and does reduce volatility, how variable the NAV is from day to day, the price, and it also reduces the drawdown. And now that we have a multi-year track record for KLIP, we're going to share some of that information as we go. Next slide, please. So one of the things I wanted to highlight is what makes writing calls on KWEB so attractive. And there's a very important relationship, almost a linear relationship, between implied volatility and the option income that can be generated in a given month. And so you could see on the left-hand side of this chart, we have implied volatility for various US indexes as well as KWEB. And the differences are quite stark. You could see that KWEB's implied volatility is roughly twice the riskiest US equity market. So the NASDAQ and the Russell 2000 tend to be more volatile than large cap, and KWEB's volatility is 2x that level. And so if you look at the chart on the right, it shows you how much option income can be produced at these levels of implied volatility. And again, not surprisingly, given the linearity, that China Internet option income is roughly 2x that of what you would get with Russell 2000 or NASDAQ. And as a result, you'll find that a lot of strategies in the marketplace that do covered calls on US equities will tend to cap their monthly income at 1%. And we've recently set our cap at 2%. Let's go to the next slide, please. Sounds like there's an earthquake here, but it's just some rattling one floor above us. So apologies for that. So another thing you may be asking is, well, how does that relationship change over time? Is this anomalous? Is this occurring because of the DeepSeek news and the volatility is just really high right now? Well, the truth of the matter is KWEB, being a concentrated basket of China securities, tends to be volatile all the time, and certainly more volatile than US equities. And with very few exceptions, it's always had higher historical volatility than US indexes like the NASDAQ, S&P, and the Russell 2000. And you can certainly see that in recent periods, the volatility has picked up a bit because of some of the goings on in the market and the increased price action. But by and large, KWEB volatility tends to hover in the 30 to 40% range, as does its historical volatility. And it tends to be quite a bit higher than what you have from US indexes. So what that means from an investment standpoint is that a covered call writing strategy on China Internet is going to produce higher levels of option income on a consistent basis. Next slide, please. And so if you look at our historical monthly distributions, when we first launched KLIP, the approach that we took was to generate monthly option income and pay it out each month. Whatever we write, that's what we pay. And you could see that going back historically, the numbers have oscillated quite a bit. In some months, we paid out 3%, in some months 4%, in some months even 5%. and a lot of things in between. But after spending time with our investors and getting their input on the behavior of the returns and the volatility of the NAV, we've made some changes. And effective this year, we're now capping that monthly distribution to 2%. Now, why did we do that? Well, when we talked to investors, they said, we really like the high levels of income that you're distributing, but if KWEB itself is in a downtrend or is having a down month or a down quarter, that is reflected in the NAV of KLIP. Because as we talked about, you have to still maintain some of that downside exposure in a covered call strategy. And that's not unique to KraneShares. That's just how covered call strategies work in general. So we also found that a lot of investors that were receiving the distributions were not rebalancing. And so if you don't rebalance your strategy over time and you don't put that cash back to work, you could be underexposed to the markets and you can't achieve the returns that we intended for investors in KLIP. So after careful consultation, we decided to cap the distribution at 2%, which is roughly half of what we would expect to make over the long term. And that's very much consistent with what US covered call strategies do. So we did a 3-for-1 reverse split at the beginning of January, and we capped the distributions. And the idea here is to maintain more stable NAV that doesn't decline quite as precipitously as KWEB has drawdowns, but at the same time offer very attractive annualized distribution rates of something in the 24% range. Next slide, please. So looking back historically, what you'll find is that since we launched KLIP back in the early part of 2023, it's done what it was intended to do. It's generated returns that were better than KWEB in a very difficult environment for KWEB returns. It generated about half the volatility because of the consistent covered call writing, and achieved about a third of the drawdown. So while KWEB had experienced a performance downdraft as high as 30% within this 2-year period, KLIP never lost more than 10% of its value because of that option income cushion that was produced each and every month. So we're very pleased by the performance, and for better or worse, are happy to show that KLIP has done well, reasonably well, in a difficult stress-tested environment. Looking forward, KLIP has better potential for return because KWEB could be in a different kind of a market. And in fact, KWEB routinely has 12 and 24-month periods where returns are up 50 or 100%. And if we're entering that kind of environment, KLIP will certainly underperform KWEB, but it may not have the kind of drawdown or volatility characteristics that it's had in these first 2 years. So if you are an investor looking for meaningful monthly income, distributed income, and a controlled way of accessing the China internet market, KLIP is a great solution. But it's not the only one we offer, and I'd like to turn things over now to James to talk about our buffered strategies.
Great, thank you, Jonathan, and thank you, Brendan, for the background at the outset here. Yeah, KLIP is certainly a phenomenal innovation, maximizing the benefit of the options liquidity in KWEB, and we thought about other ways we could benefit or have our investors benefit from the options environment on KWEB, and had heard from investors around the volatility element of the KWEB investment that what would really give them the most confidence going to market in a KWEB exposure and a China tech exposure would be some sort of buffered exposure, some sort of downside protection. And if we could bring that to market, that would certainly be of interest. So after doing some work and kind of thinking about the right strategies, the right blend of protection and upside capture, and seeing what might be achievable using KWEB options, given the implied volatility and skew characteristics in the market. We were able to bring KBUF and KPRO to market. So both of these funds provide an element of downside protection. And we were able to achieve, again, healthy levels of upside capture in both strategies over the 2-year return period. And what this allowed investors to do, again, was to get that KWEB exposure, that KWEB-like exposure to the China tech space, which has such a phenomenal potential for longer-term gains, and do it in a way that's volatility dampened and provides some protection. So we launched KBUF and KPRO a little over a year ago in January of 2024, and we're able to put on those protection levels with attractive upside capture characteristics, just north of 40% for KBUF over 2 years, and just north of 20% for KPRO over 2 years. And it's really tough to time markets, but as luck would have it, shortly after launching both of these strategies, KWEB had a really nice rally, which is obviously greatly to the benefit of KWEB investors. For investors in KBUF and KPRO, starting from the point of protection when we launched the funds, as KWEB rallies from that protection floor and kind of approaches the upside cap, we saw that rally in KWEB over the ensuing year, and had an opportunity in January of this year to restrike both of these strategies. So essentially to reset the floor for both strategies to be more relevant to the current price of KWEB. So again, the current price level of KWEB as of late January, when we were able to restrike. And we were also able to raise the ceiling for upside capture for both strategies. So allowing those strategies to continue to be relevant to the current state of markets and the current state of the price of KWEB, and refreshing those levels has caused many of our investors to take another look at these strategies. It's important when you think about investing in buffered strategies to be aware of the current price of the underlying, and where those strategies stand and what those strategies offer each day relative to the underlying price. So we have a section on our website, on KraneShares.com. If you go to each of these product pages, you'll see a current up-to-date to the current day analysis of where the price of each of these funds is relative to the floor and ceiling levels. But the ability to restrike these funds about a month ago has allowed for us to continue to provide that level protection for any downside risk, and still provide really healthy upside capture over the 2-year period. We can move on to the next slide. So a little bit of kind of nuts and bolts of how the strategy works for the suite. Similar to KLIP, these strategies own KWEB, and we sell out of the money call options on KWEB. Next, we put on another couple of options positions. We buy out of the money put options to provide that downside protection that we offer, and we also buy at the money KWEB put options for KPRO to provide that protection level. So you can see here getting a little bit under the hood of the strategy and how we use a combination of the exposure to the KWEB ETF itself, as well as options on KWEB to provide these downside buffers, downside protection, as well as the upside cap. If we move on to the next slide. we can look at the performance for KPRO and KBUF in 2024, and how it allowed us to extend the outcome period and reset the buffers. So initially, in the launch a year ago, we were able to write 2-year protection. And as I mentioned, the price of the underlying KWEB rallied significantly in that time period, and it had a similar effect on the performance of each of these funds, KBUF and KPRO. And what we were able to do then is extend that period to January of 2027, essentially resetting those options contracts to raise the floor on the buffers and raise the ceiling on the caps. So now we have another 2 years almost of these outcomes available to investors for KBUF and KPRO. Go to the next slide. Here's a look at valuations and KWEB's price to earnings multiples. Again, as Brendan mentioned at the outset, and happy to have Brendan or Jonathan chime in at any point here. But what we're seeing here is PE ratios for KWEB over the period of time from November of 2022 up to the present here in February 2025. And what we can see here is price earnings levels that are significantly lower than certainly what we've seen historically in this space, but also what we see for US tech, and thinking about valuation and being a value investor. And essentially, I know there's a lot of experienced investors on this call, and a lot of people who understand the basic tenet of investing is buying low and selling high, buying inexpensive assets and selling more expensive assets. And even though we've had a bit of a rally here in KWEB and China tech and some incredibly positive kind of fundamental stories coming out and great qualitative information, when you look quantitatively at price to earnings and traditional valuation metrics, KWEB remains incredibly inexpensive relative to certainly its peers in the US tech space, as well as where these names have been historically, looking back over a period of years. And now we look at KBUF and KPRO in 2024 relative to KWEB and the performance characteristics of the three funds relative to one another. Over this period, we have a KWEB annualized return was just north of 50%, with annualized volatility of about 33%, with a 26.5% drawdown. That's for KWEB. Similarly, at the same period for KPRO, we had just under a 16% annualized return, with annualized volatility about a third of that of KWEB, coming in just below 11%, with just a 4.3% drawdown. And for KBUF, a return of just under 25%, annualized volatility of just under 20%, and then a drawdown of just about 9%. So you can see very attractive characteristics in terms of dampened volatility, but still producing a substantial amount of the return of KWEB. Just a much smoother ride in KPRO and KBUF with those protection levels in place. Moving on to the next slide. Looking at correlations, which again is I think an incredibly powerful data set here. Thinking about correlations of KWEB versus other global indices, certainly 0.4 correlation to US large cap is represented by the S&P 500, 0.38 to the Russell 2000, 0.46 to the NASDAQ 100, and then 0.33 to S&P 500 dividend aristocrats, and then to a high yield index, the Bank of America US high yield index, 0.25 correlation. So again, very low correlations to other large asset categories, and another element of the attractiveness of KWEB as an investment versus the other large global indices. And in conclusion, before we move to Q&A, and I do see we have some questions coming in already, which is great to see. We want this ultimately to be for the benefit of our investor base and our audience here. So we encourage questions and look forward to addressing any points that are most of interest to you. So please go ahead and use that Q&A field. But as we conclude, just to recap a couple of the key points, the efficiency with which DeepSeek's large language model was developed suggests that chip shortages may no longer be a risk for China's internet gains and AI leaders, which include some of the largest names in KWEB: Alibaba, Tencent, Baidu, and Kuaishou. It really was a revolutionary moment, seeing these kind of really advanced language learning models that exceeded the performance of some of the large kind of household name models from some of the US AI companies, and really is a testament to the level of innovation and resourcefulness that the Chinese internet leaders are showing in their development of AI. Really represents a sea change in how we should think about this space. Brendan, do you want to talk about, I know these are points that you're passionate about for the rest of the items here.
Yeah. I mean, I think in general we're quite constructive on the space. At the same time, we can't predict the future, and we know that KWEB, to Jonathan's slide, KWEB has shown some high volatility, and I think there's ways we can harvest that volatility via KLIP. At the same time, again, we can't predict the future, and as constructive on the space, there are ways that both KPRO and KBUF can help mitigate some of that volatility associated with holding KWEB outright. And I know, just we can tell we've got some good questions. I know we've got some compliance slides to get through, but again, I think a lot of the questions are just, we chose that 2% barrier, kind of cap, James and Jonathan, and what happens to that, any excess above that 2%, when and if would that be paid out? It's kind of a common theme from a question perspective. So can you kind of speak to, where, anything above that 2%, where does that go? When and if is that paid out?
Sure. So, historically, when we first launched the strategy, we wrote the calls, we generated option income. Let's say it was 4%, then we paid that exact amount out. Now, if we, write the calls and we generate 4% of option income, 2% of it is paid out, 2% of it is reinvested back in the strategy, which in effect puts it into KWEB. So what you would expect to happen now versus before is, kind of higher relative exposure to KWEB as part of the strategy. And just, keep in mind, the reason that we took this step is a lot of the feedback that we were getting is that while people really loved the income production that was coming from KLIP, they didn't like the NAV volatility. And so this is something that we had to really think hard about. This was not an easy decision, but we did consult with a lot of investors on this. And now we're getting a lot of very positive feedback. We're seeing new investors coming into the strategy because, quite frankly, the 2% monthly cap is quite attractive. As I'd mentioned, it's roughly twice the level that's being offered for US equity ETFs that are doing covered calls. And this capping mechanism is very common in the marketplace. And that is to control some of that NAV volatility, right? Investors are buying covered call strategies in part because they want to generate income, but in part because they want to control volatility of their NAV. So this is a way to balance both of those things. And the reality is, if investors are seeking to achieve a higher rate of distribution, it's something that they can do in addition to. So, for example, if we're paying out 2% and you wish to generate a higher distribution rate, you're actually able to, sell down that additional 2%. So there are ways to customize use of KLIP, just like some of our investors that utilize KLIP will actually blend it with KWEB in some capacity. So some investors want growth and income. So they'll actually invest allocations and blend the two together. Because as you can see on the slide, there really is an entire spectrum of volatility and drawdown that you can manage by putting those two things together. KLIP volatility of 22 in this case, KWEB close to 40, drawdown of -10 to -30. So you can literally pick and dial up or dial down your income and growth combination depending on your own portfolio needs.
Okay, so again, so if we pay out 2% and say the strategy actually generated 5%, that 3%, just to confirm, when would that get paid out to shareholders, Jonathan?
No, that goes back into KWEB. So
goes back into the NAV.
So what happens is, as the NAV grows, you have higher income potential. And that was some of the feedback we were getting as well, right? If somebody bought KLIP at, say, $25, and because we've made significant income distributions, it's only at 20, even if you're making a distribution rate that's still in the 4 to 5% range, it's off of a smaller NAV. And so investors were saying that they would prefer to keep their income dollars more stable and their NAV more stable. And so we've done a lot of testing, a lot of analysis, and this 2% level, we believe, is the sweet spot in getting, another way of saying it is to have total returns and income returns be more closely aligned.
Okay. And yeah, I mean, I think myself as a shareholder in KLIP, there was a period where, yes, you're making a higher yield, but unless you were reinvesting, it's off such a small, you might be getting 5% a month, but if you're receiving the full 5%, you have 5% less exposure on a monthly basis. So you have that,
That's right.
This huge disparity between total return and return.
That's right.
And this is a way to try to balance that.
Exactly. So we're in effect rebalancing on behalf of the client to make the income pattern and the NAV pattern more stable. And that's the feedback we got. And many of the things that we do at KraneShares is based on input from our clients. We're a very client-centric firm.
And let's be clear, we're still talking about a 24% or thereabouts, annualized distribution rate. It's incredibly healthy. I don't believe there's anything else in the market that offers anything close to that. And again, achieving a balance between that incredibly healthy distribution rate on a monthly basis as well as an annualized basis, and also continuing to have more NAV stability and more of an ability to experience a bit of kind of compounding over time within the strategy. So again, we welcome feedback. Nothing is more valuable to us here than hearing from investors and having the conversations and understanding when we provide an exposure, when we have a fund in the market, what the investor's experience is with that fund. And we're always thinking about achieving the best outcomes to meet our investors' goals. And thank you to all of our KLIP investors for your feedback. And we expect that this outcome will achieve a lot of the efficiencies and a lot of the benefits that we've discussed with you over the past year plus.
Yeah. It might also be worth mentioning that James, the correlation chart you showed, that naturally extends to KLIP, KPRO, and KBUF. So as well as KWEB is correlated or say not correlated to major U.S. equity indexes. If you're using U.S.-based covered call strategies, KLIP is a very good diversifier within that category, right? Because your US-based covered call strategies are subject to drawdown risk, but the drawdowns that you're going to see in a KLIP are going to occur at a different time than they would on an S&P-based covered call strategy or a NASDAQ-based covered call strategy. So the importance of this slide extends well beyond KWEB and all of its related strategies as well.
Yeah, and in theory, just to your point, Jonathan, that extra income level, one could always sell just a small piece of their shares to generate any shortfall from the,
That's right.
from, just above that 2% level.
That's right.
And thinking about the kind of the other side of the possibilities there, and frankly, when we launched the fund initially, we thought we'd see some portion of our investors actually reinvesting and enjoying that compounding. I think when you think about the weighting in a portfolio and the size of your investment, when you do have something that's paying large distributions on a monthly basis, the onus is really on the investor to reinvest if they do want to enjoy that compounding and maintain that weight in the portfolio. And I think that's something that does take an extra measure of time and focus for investors to do if they so choose. And what this balance, this 2% cap on distributions, and essentially retaining any excess beyond 2% that we achieve in terms of options premium from the selling the calls on KWEB provides an element of that as well, kind of puts that rebalancing reinvestment on a bit of autopilot. So certainly if an investor wants to realize more of the benefit beyond that 2% that we'll be paying out monthly, more of the benefit from the options premium that we're earning, they can do that by trading, rebalancing, adjusting the size of their position. But similarly, on the other side, if they want to realize the full benefit, and if you think about, Warren Buffett said it many times, I think Albert Einstein also said the most powerful force in the universe is the power of compounding interest and compounding over time in your investments. So you have a strategy like this that is generating significant, income, thinking about reinvesting all of that and allowing that power of compounding to go to work with all of that income is something that also may be of interest to some investors.
100%. Yeah, and this is a few questions just around if people would like to receive the deck. That's definitely available. Just if you email us at info@KraneShares.com. And certainly for the replay as well, we'll have that up and running, hopefully within a day, if not sooner. So we can definitely, if you'd like to receive a link for the replay, just again, please email us at info@KraneShares.com and we'll get that replay out to you. And I know we're at the top of the hour, but yeah, certainly, James, Jonathan, I think that's fantastic and great insight into the rationale behind our thinking on the adjustment to KLIP, and then certainly the resetting of the caps on KPRO and KBUF. And certainly, every time we reset those caps, we seem to catch a great movement in KWEB. So we might want to have to do it again.
That's right. That's right.
With that, thank you again, and certainly looking forward to keeping up to speed as more developments occur in the China internet space.
Thanks, everyone.